Hi, Jim Marr back with you for the second session in Corporate Issuers. Hope you're doing well. So what are we going to cover today? We're going to take a look at capital investments and capital allocation. Then we'll move on to capital structure, and we'll wrap up today's review with a talk about business models. First up, we got our capital investments and capital allocation. Very important part of this topic area. Capital allocation is a process of planning expenditures on assets whose cash flows are expected to extend beyond 1 year, or for example, something that is long-term in nature, a long-term project where we're going to be analyzing the cash flow. I'm going to talk about NPV and IRR in order to come up with an investment decision. And there's a number of capital projects. There's 4 types that are discussed in the curriculum. And first, we got a going concern project, and that's simply to maintain the business, improve efficiency, or reduce risk. Then you got your regulatory or compliance projects, and those are generally imposed by a third party. You might ask yourself, hey, Jim, what's a third party? Well, maybe that's a government. And that could be for safety, compliance, regulatory, and supervision standards. Pretty straightforward. Then you have the big one, your expansion projects. Maybe you're expanding your business side, the scope of the business, investing money in R&D and mergers and acquisitions within the core business. Maybe those are considered low risk. Then we have new lines of business and other. That would be R&D, M&A once again, and investments outside the firm's current business. And you can see we're making a little bit of a contrast when we're looking at expanding projects within our line of business is a little more of a low risk, where when we're expanding to new lines of business, that'll be a little more on the high risk, where here you might be entering new markets and also introducing, say, new products. So what is the capital allocation process? Well, you need to know all 4 for your exam. I think that would be a safe bet. And whenever you see TQ on your screen, that's where I think a test question could be lurking. So first up is the most important step. And see, I like that right there for a test question. And that would be our idea generation step. Then we want to analyze project proposals. And that's sort of going back when I talked about cash flows. So we're going to look at the expected future cash flows on the project. Then we're going to create a firm-wide capital budget. And then we're going to monitor our decisions and conduct a post-audit. In other words, what we're going to do here is we're going to look at comparing our actual results on the project versus our projected results. And hopefully our actual actually was higher than our projected. That'd be even better, if you will. All right, next up we're going to talk about NPV, or net present value, and IRR, which is the internal rate of return, and these are measures to determine whether or not a company should take on a new project. And if I'm a betting man, I would say you're going to see these on your exam, one or both of them. So first up is our net present value. And here all we're doing with NPV is using a, say, fancy formula, which, just tuck that away. You're going to be using your calculator to make these calculations anyway. So first up, you got your discount rate, and that's the cost of capital to the firm conducting the project, and say that would be your interest rate that you'll be using in your calculation. And you're going to, I'm sure, have run across practice questions already using this. We're going to accept, and here's our decision rule. We're going to accept the project if the NPV is greater than 0. So I'm going to put a big star by that, commit that to memory.